A bank reconciliation statement is a document that matches the cash balance on a company's balance sheet to the corresponding amount on its bank statement. The reconciliation process will help determine if there are any underlying issues. They're often used to ensure that there's no fraud or account errors or manipulation going on at a company. Let's take a closer look now at some of the reasons for performing a bank reconciliation analysis. One of the most common reasons is to account for deposits that are in transit. Cash and checks may have been received by the company but not recorded at the bank yet. There could be outstanding checks that have been issued and recorded by the company but not deposited and thus not reflected at the bank yet. There could be bank service fees, and due to the timing of those fees, they may or may not be reflected in the bank statement. Interest income and its timing can also be a factor, as well as instances of insufficient fund checks that have been deposited. These are 5 of the most common, although there are more reasons as well. Let's look at the procedure for performing a bank reconciliation analysis. You'll begin by comparing the company's issued checks and deposits to the checks that are shown on the bank statement to identify any uncleared checks and deposits in transit. Then you're going to use the cash balance on the bank statement and add back any deposits that are in transit. You'll also deduct any outstanding checks. At this point, you arrive at the adjusted bank cash balance. Now, starting from a different point, you take the company's ending book cash balance, which is the company's cash balance on its balance sheet or its internal records, and then add back any interest earned and notes receivable, deduct bank fees or insufficient funds to arrive at the company's adjusted cash balance. After the reconciliation has been formed, the adjusted bank balance should match the company's ending cash balance. Let's look at an example together to really make the point. Here is a series of information about a company. We are going to take all of these data points and use them to perform the bank reconciliation analysis. Please note down these numbers if you want to try it on your own. As you'll see in the solution here, we take the ending bank balance, deduct any uncleared checks, add any deposits that are in transit, and we get the adjusted bank balance. Then we perform step 2, which is taking the ending book balance of cash, deducting any service charges, adding interest income, deducting any errors, adding any notes receivable, and then deducting any insufficient funds. Then we get the adjusted book balance, and you'll notice that these two numbers are the same, so we now have confidence in our reconciliation analysis. When we piece it all together, we produce a statement that looks like this, where we have our bank reconciliation analysis. We've clearly labeled it with a title and an ending period date, and then we're showing very clearly how the two adjusted cash balances are equal to each other and all of the items that have impacted them. Thanks for joining us for this quick tutorial on bank reconciliation statements.